have Craig Erlam on the line. He is a market analyst at Alpari UK. Craig, thank you so much for joining us today. How are you doing?
I'm very good. Thanks for having me on. How are you?
We're doing good over here. It's a little cold in the Midwest, well, a little more than a little cold, but we are hanging in there. So let's start off with the ECB. The euro has slid to 9-year lows. I know on our show before you've said that the ECB, it would be difficult for them to do quantitative easing because they would have to buy up all these different types of bonds at different classifications that have different amounts of risk. So we've got this meeting ahead at January 22nd. I mean, what are your thoughts right now?
Well, if I'm perfectly honest, I'd say my stance has softened slightly on the ECB in terms of quantitative easing. Clearly, there's so much speculation in the markets right now that QE is coming that it's you can't ignore it. You can't just stick to what your initial thoughts were. Maybe the ECB has run out of options. Maybe they've tried other alternatives, TLTROs, asset-backed security purchases, end of sterilisation of bond purchases. They've clearly seen that these aren't working. So potentially, maybe they are now seriously considering quantitative easing. The questions I now ask is, what form is it going to be in? Is it going to be the type of bond purchase which you've seen elsewhere, which, as I've mentioned before, is extremely difficult, made even more difficult now by the fact that we've got a Greek election at the end of the month in which an anti-austerity party, not as much an anti-EU Eurozone party anymore as they used to be, but an anti-austerity party nonetheless that would look to renegotiate the terms of the bailout. That comes only a week after the next ECB meeting. So can we see QE at the meeting on the 22nd? If so, will they disclude Greek bonds as part of this QE package, or will they delay it by a couple of months and see how that pans out? But even then, they've got further issues down the road, because if this anti-austerity party in Greece comes to power, what kind of a precedent does this set for the rest of the eurozone, where we also have elections in Portugal later this year? We've got elections in Spain later this year, which two other economies which have been extremely hard hit by all this austerity over the past few years. Say a Syriza party wins this election. Say they renegotiate some terms of the bailout, soften the terms of this bailout in order to help the economy as they have vowed to do. What kind of a precedent does this set for these other countries? Does the anti-austerity parties in Spain and in Portugal then start to gain in popularity because people see an opportunity to bully the EU into softening the terms of their bailout as well? So I think there's still a lot of complications with regards to quantitative easing for the eurozone. I think the ECB may now announce some form of QE. I'm not even convinced still it will be this month, but I do think there is going to be. It's not going to be QE in the form that we've become accustomed to. I don't think it's going to be straight bond purchases. I just feel like there's going to have to be something a little bit different about this one.
If you had to take a guess on what the form of their QE would look like, any idea at all?
Well, it's like I say, it's very difficult. They could, of course, do it by rating, so they could claim that they're going to only purchase bonds which are above a certain rating, or not junk bonds effectively. They could say that they're only going to buy purchase bonds where there is no bailout program currently underway. But again, I guess if they do things like this, then what problem are they actually solving? Yes, they're filling a system with liquidity, but there's already plenty of liquidity in the financial system. What's broken is the transition mechanism, which allows that cash to flow to the banks which need it most, which flows to the economy which need it most, and boosts lending to these businesses and to these households. This is the problem that the eurozone has right now. It's not a liquidity battle. It's a battle to get that liquidity to these real economies. All we'd really see from quantitative easing, if you did discount these countries with low rated bonds and with higher yields, is you'd effectively be ploughing money into yields which are already low. Let's take a look at like the short term bund yields are actually negative. If we look at longer term bund yields, they're at record lows. French yields are at record lows. Italian, we're seeing the same thing. What can quantitative easing actually achieve right now that it wouldn't that other measures couldn't? And I think this is the question the ECB is being asked quite strongly right now, and this is what makes trying to anticipate exactly how they'll approach this so difficult.
And so let's just go back to the Greek situation, and I guess from Draghi's perspective, this meeting couldn't be, at any worse of a time. Here you're having the meeting on the 22nd. They're having the election in Greece on the 29th. Now, if things go according to plan, Greece may be succeeding from the European Union. If he doles out the money now and Greece gets a part of it, that might influence the elections. Do you think he just might stall a little bit longer, get rid of Greece, and then move forward with the quantitative easing?
Well, I guess the problem he'd face with this is that if this Syriza party were to win the elections, and at some point down the road, the Greece was to leave the eurozone, which, to be honest, if I'm honest right now, I don't think that will happen. Even if
No.
Syriza comes to power, their stance has softened quite significantly since a few years ago when they were running in the previous elections. So I think now they're not so much an anti-euro party as much as an anti-austerity party. They want a lot of these conditions to be revoked. They want to increase spending in the country and try and drive some growth here rather than focus on austerity and reforms all the time. They're not so much of an anti-euro party anymore, and therefore, while they may try and drive a hard stance, I think the chances of a Greek exit now remain low. But the problem is they're still more heightened than they would be under the regime which is now coming to an end as we head into the election. So these risks are still there. And if there's while Mario Draghi and a couple of the board members may be willing to take this risk, or even just adopt quantitative easing but not include Greek bonds for now, I don't think countries like Germany will be interested in this, because Jens Weidmann has already been a very strong hawk among the ECB, very much against quantitative easing because they consider this to be fiscal funding these governments effectively. We know there's no support in Germany publicly for any more support for Greece, especially if they're now heading into an election period where, as you say, there is a potential at least for Greece to leave the euro area. And if there's no support among the public, then there's going to be no political support from Angela Merkel, or that's how you'd imagine things will be. So I think, like you mentioned, this is a very difficult period for Mario Draghi. It comes 1 week before the election, the absolute worst time this meeting could come, which is why I think it'd be extremely wise for Mario Draghi and the rest of the ECB to wait until the next meeting 6 weeks later, when they can make a more informed decision, not just on Greece, but also on Spain and Portugal as well, which, as I mentioned earlier, have elections later this year. And if the Syriza party is successful in winning the election and renegotiating some of the terms of the bailout, then Mario Draghi and the rest of the ECB have further issues down the line, because I would imagine that these anti-austerity parties in Spain and in Portugal would start to feel a lot more confident about their own elections.
Craig, I have to ask you about oil. We finally broke below the $50 level, first time since what, 2009? I mean, do you think we're going to start seeing $40 oil soon?
Well, I think that's certainly a possibility. I guess the issue we have with oil right now is that it's being driven largely by a significant, this large supply glut due to this U.S. Shale, the new U.S. shale industry, which has increased supply quite significantly and given OPEC some real competition here. It's also been driven a little bit as well by falling demand in the likes of the Eurozone and China. And therefore, with these fundamentals still in place, it's hard to see, imagine a reason why we'd see it not break below 50 and not head towards 40. Now, 40 I think is going to be a very interesting level, because I think 40 is being widely touted as the level at which it's not just a case of these companies not making money anymore. It's around this 40 level, which companies in the US and also other areas of the world, it goes away from not making money anymore to actually going bust and running into serious financial difficulty. So I think while we will still continue to see a decline, probably to 40 over the next month or two, when we're looking at the rate of decline that we've seen over the last 6 months, I think that is what's going to slow. We've already seen Brent crude hold up around that 50 level over the last 24 hours, although what we've really seen is a bit of a dead cat bounce. I don't think we've not really seen too much of a rebound, but it's the rate of decline, because it's at these levels which I think the major banks' buying interest is going to start to pick up. If they see 40 as being a big cut-off level where all these companies are going to run into difficulty, which will affect supply, so we don't need to even wait for an announcement from OPEC or the US or anyone else to say that they're going to start cutting supply. That doesn't need to be what we need. Isn't what we need to see. If we know that companies are going to run into financial difficulty and have to be forced into cutting supply around this 40 level, level, then it's when we approach that the big players in the industry are going to start to look to buy. Because when you're looking at 40 and people are saying the fair price of a barrel of oil at the moment is between 70 and 80, then your risk reward is so strong, and it's the big banks and the big players in the industry that can afford to take the risks at that stage.
What about gold? Are we seeing another false rally? I mean, do you really think it can hold the 1200 level?
I think it can for now. I think with gold, it's almost quite frustrating in that I think what we're effectively seeing right now is a long period of consolidation. We saw those massive moves last year. Once we eventually started to see the talk about the end of quantitative easing, well, I say last year, the year before. I think time's just going too quick right now. But we've seen so much consolidation, and I think that's exactly what we're going to continue to see. I don't see any massive declines on the horizon. I think we are above 1200 at the moment. I think we could even see this rally into 1240s, 1250s. But I think above there, that's when we're going to start to run into plenty of resistance again. I think 1260s, 1270s even may have the potential to be hit. But I don't see any significant rallies because I just don't see what's supporting gold right now. For example, you've got the Asian market. It's this time of year that the physical gold purchases tend to rise quite significantly with the holidays just around the corner, and this could be supporting speculative gold trading as well. We do tend to see more buying in gold around this just in the lead up to these holidays. But I think in the longer term, if we're looking at a year, 2 years down the line, I think there's only one direction for gold. We're in a low inflationary environment right now that's expected to be sustained. We're talking about raising interest rates by the Federal Reserve later this year, early next year, raising interest rates by the Bank of England. And I think once we start to see this all start to go into motion, I think that's when we'll start to see gold move back towards that $1,000 an ounce level. But for now, I think it's been well supported probably by physical buying in Asia.
Okay, so we got the FOMC minutes yesterday. What are your thoughts on that? And do you think the Fed's going to raise interest rates this year?
Well, I don't think we necessarily learned a huge amount from these minutes. I think they are going to raise rates this year. I think one of the things which they did touch upon, which was, I guess, something that was already quite known in the markets, is the fact that we've seen this falling inflation. We've got deflation in the eurozone. We've got low inflation in the UK. We're seeing falling inflation in the US, but by no means to the extent that we've seen in these other countries. Now, I think there's going to continue to be this lower inflation pressure in the US, but what we're actually seeing in the US compared to many of these other countries is we are going to start to see wage pressures pick up. We've got this unemployment now, which is expected to fall to 5.7% when the numbers are released tomorrow. Very close to that level that the US Federal Reserve considers to be full employment. We are starting to see wages pick up. Once wages pick up, you do tend to naturally once we move past this period of excessive spare capacity, that's when we start to see inflationary pressures pick up. And the fact that the US hasn't been as hit as hard by this disinflationary environment that other countries are suffering as a result of so much. Once these wage pressures start to pick up, I think that's going to bring that inflation figure back up towards that 2% level. And I think the Federal Reserve is confident of that, and therefore I still think June is going to be the point at which we see that first rate hike from the Federal Reserve.
Okay, and you already kind of touched on the last thing I really wanted to get your thoughts on was this jobs number that we're going to have coming out tomorrow. I mean, the one we got in December blew everybody's expectations out of the water. Do you think we'll see something similar?
Unfortunately, I don't. It would be nice if we could see something similar. There's nothing we should be happier about than a booming jobs market, a strong economic recovery for the US, the world's largest economy, hopefully driving that recovery elsewhere. But if I'm perfectly honest, expectations of 240,000. I wouldn't be surprised if we actually fell a little bit short of that. The 321,000 figure from last month, I expect to be revised lower. That was so far above people's expectations for the month of November that I wouldn't be surprised to see that revised slightly lower. So I think people are going to be a little bit disappointed at this payrolls figure tomorrow, as well as the revisions. But one thing I think is worth highlighting is as long as we see another number above 240,000, above 200,000, this will be the 11th consecutive month that we've seen 200,000 plus jobs created in the US, and that is absolutely phenomenal. That is something we haven't seen in years, and that is a real clear sign that this economy is on the mend and it's going from strength to strength.
We've had Craig Erlam on the line. He is a market analyst at Alpari UK. Craig, thank you so much for joining us today. We always truly appreciate your insight and analysis from across the pond.
Thank you very much for having me on again.